Wonderful. So good morning, everyone. Welcome to this wonderful session. We're going to look at the national budget and also the Finance Act 2026. My name is Masiki Malat. I'm the CEO for ASEC, which is Association of Startup and SME Enablers of Kenya. What we do as a network is that we bring together different entrepreneur support organizations, including incubators, accelerators, venture builders, investors, any entity that is supporting entrepreneurs to start their business, grow, and scale. And one of the key things that we do under the association is on our policy and advocacy pillar, where we look at how do we work better with governments, regulatory bodies, and different institutions to actually enable the environment through favorable policies that can actually support SMEs, startups, MSMEs, even large enterprises to thrive and grow, because we understand that entrepreneurs are the ones that actually create the jobs and also achieve the social impact we're looking for. So today we've partnered with Keldin CPA Associates, where they're actually going to walk us through the different components for the Finance Act 2026. And it's actually quite important for you as an entrepreneur or a business owner or even advising enterprises to really understand what has been put in there. And then also the national budget. So understanding also the priorities of the Kenyan government and how you can best align towards that. So as I kick off, I'd like to invite Joseph, also who's our treasurer at the board level, but also is a partner at Keldin, to also do the introduction, and I hand over to him. Welcome, everyone, and please use the chat to introduce yourself, share more about your business. Let's also use this as a platform for networking. Asante, and over to you, Joseph.
Thank you. Mercy, good morning, members. Mercy, somehow I'm not able to turn on my camera. I don't know whether you can enable me from the other side, but if not, I can just proceed. So good morning, distinguished guests and members. We are happy to have you this morning for this very important conversation of our national budget, as well as the Finance Act 2026. Why this conversation is critical, as many of you may know, that we are operating in a political environment. Every jurisdiction, every country in this world is a political territory. And what that means is that the decisions made by the political class in one way or another affects you as an individual first, but also as an organization, as a business, as an entity. There is direct implication of all the policies the government enact and all the decisions the government make. As a matter of fact, all these decisions are targeting either individuals or corporates. So to the extent you are operating in that space as corporates or as an individual, then these decisions affect you in one way or another. Then what that means is that you should stay updated and you should be in the know as far as these decisions that are made. And why that is important is so that then you position yourself accordingly to take advantage of those decisions, so that instead of being a victim of circumstances, then you should be a master of them, right? So when government sit down and makes some of these decisions, then you ask yourself, how then can I as an individual benefit from it instead of being disadvantaged? How can we as an organization take advantage of some of this? How do we then change operations? How do we tweak our plans? How do we adjust our intentions and objectives so that we benefit from some of these changes as opposed to suffering from them? So that is why the budget discussion is critical. Secondly, normally the budget is a reflection of the priorities of the government for the next 1 year. And what that means then, as an organization, you ask yourself, how do we align ourselves with these priorities? so that then it works to our advantage. The Finance Act just shows the changes in the taxation landscape, and tax affects all of us. There are two things that are certain in this life. That is death, number one, and number two is tax. Those are certain things. They are very certain, and you cannot run away from them, regardless of who you are, where you're operating from, and in which industry. And so it's also critical that you know what are some of the changes that have come up. And there are so many, as you are going to see. And what we are going to do in this session is to break them down. And so by way of introduction, I know Mercy has already introduced us, but allow me just to take it a little further. So my name is Joseph Wande. I'm the Tax and Accounting Services Partner at Keldin & Company CPS. We are an accountancy firm that provides accountancy services. Our key service lines include tax consultancy, and under tax consultancy, we have things to do with tax training, like what we are doing today. We also help with tax compliance, that is the day-to-day filing of your tax returns, VAT returns, withholding tax returns, pay as you earn returns, annual corporate income tax, and even individual income tax at the end of the year. So that is tax compliance. We also provide such services as tax advisory. So as you may know, every commercial transaction has tax implications. And the question is, are you aware of the tax implications that accrue to your commercial transactions? So we come in to provide tax advisory services. All the plans you have, all the intentions you have, that contract you're about to sign has significant tax implications. The question is, do you know them? Or will it crystallize and affect you negatively? So we provide tax advisory services. Something else that we provide under tax services is what we call tax dispute resolution. So I mean, all of us operating in this space will know that at some point you are at loggerheads with the Revenue Authority. The KRA will come to audit you. At some point, the Revenue Authority will come to say that, you owe us this much, and you disagree. So when you disagree, then you enter what is called a tax dispute. When you enter a tax dispute, then managing that is critical, because you can be a casualty or you can come out victorious depending on how you manage it. And so we come in between you and the Revenue Authority because we understand where they're coming from, we understand the tax laws, so that then you come out as a winner. So if you have any such issues, you've received notice of audit, or Revenue Authorities giving you a demand notice which you disagree with, then that falls within the tax dispute resolution. We also provide what we call tax health check services. That is it's more of the normal health check you undertake at the hospital, where you say, look, I'm fine, but I just want to check whether there's something that I am not aware of. And the doctors will undertake some checks and tests. And then they tell you, by the way, you have stage 2 cancer and you're not aware. And so whereas you feel you're fine, through a health check, you realize that there's something serious. So we also do that from a tax perspective. You may think you're compliant until an independent party comes and reviews your operations, only to realize that you're sitting on a serious risk. So that is called tax health check. And especially because of the current ongoing tax amnesty, then that becomes critical. So tax is the first service. The second service is audit, and the normal audit, as you know them. And then we have accounting services. So if you do not want the overhead of hiring a full-time in-house accountant, then we have a solution that will help you get your taxes done at affordable price, and you get your books done also without the need of an in-house accountant. I've just put some links to some of the products that we have that targets small businesses, especially your members. Now, allow me to go straight, and Mercy, just confirm you're able to see my slides and that they are moving from your end.
Yes, they are.
Oh, thank you. Thank you. So we are two of us. So I'll at some point invite my colleague, Faith Mungai, who is a manager also in our tax and legal department, together with our senior associate, Alvin, who will take us through some sections of this presentation. So I'll go straight into it. So at the back of every budget lies the realities as to the economy of the country. And the context that the economic realities of the country present then paints a picture as to the efficiency and effectiveness of that budget. And so to start us off, I'm going to give you a brief economic overview of our country as of around June, to set the stage and to give context to the environment in which we are operating. And so from a GDP growth, we have presented some graphs there that shows a comparison between the global economy as far as GDP growth is concerned, Sub-Saharan Africa economy, and our country, Kenya. And you'll see that our country is performing very well if you look at it from a global and Sub-Saharan economy perspective. If you look at it from East Africa, I think Uganda is growing faster than Tanzania. But Uganda is just because of the oil, or the projected growth is higher because of the oil that was discovered there. We are hoping that that will go as they plan. Yeah, but our economy is growing fairly well as far as the projections are concerned. And you're going to see it was projected to be at around 5.6. The same has since been revised by the Central Bank and the World Bank to around 4.7. But that is still fairly stable growth rate, much as it has dipped a bit. And some of the issues that are affecting our GDP growth is the oil price shocks. Then you will notice that since the war between US and Iran started, the tensions between the two, the cost of oil has increased, and the government had to reduce the VAT rate on oil to 8%, and so they sustained it for up to October. And they had to bring in subsidies also to just cushion that, but that's not sufficient because we still are in the oil price shock, and as a result, then the GDP growth rate has been affected to a large degree. And this is not only Kenya, but it's a global issue. And we were hoping things will be better, but as you've heard recently, Iran is still not very happy, and plans probably to even retaliate. So we are hoping that things will get better. Then, of course, the Middle East conflict, there are quite a bit of hostilities in Middle East. Of course, all of us now are aware of Strait of Hormuz, something we didn't even know existed. I don't know about you, but I didn't even know there's such a space at the sea called Strait of Hormuz. And this has consequently driven the cost of shipping. Right now, shipping is very costly, and we import quite a bit of the things we use in the country. And so when shipping costs shoot, then it means the cost of business, cost of commodities also will follow suit. And something else that has happened is that the cost of fertilizer has risen. A huge bunch of the fertilizer that we have in the country also come from mostly Middle East, but also from Russia and Ukraine, and the wars there then means that the costs will go up. Now, when fertilizer go up, is a key and critical component or input in agriculture. And when that happens, and because of our soils today, which have been degenerated over time, there is heavy dependence. For some of you who are farmers, there is serious heavy dependence on fertilizer. Actually, as a farmer, if you can get a virgin land, you'll be lucky, because then now you will be careful on how to use some of these things. to ensure that then you are not heavily dependent on fertilizer. Because when fertilizer costs go up, then the basic commodity, which is food, the prices will go up, and that will lead to inflation, and that then will squeeze GDP growth. Something else, of course, there are other downside risks from IMF, which has been raising amber and sometimes red flags, and that then bring trade policy uncertainty. And some of these multilateral institutions, whatever they bring, they escalate any geopolitical issues and see our country as a risky place, then it affects quite a bit of multilateral trades and bilateral trades, and that then injure the economic development and growth. Something good is that Sub-Saharan Africa is quite a bit, there's quite a bit of resilience in Sub-Saharan African countries. And the growth rate, which is projected at around 4.1 to 4.3, is way above the global growth rate. Although in my view, that growth rate should be way higher because we are an emerging economy, and for us to sustain this, then it means our growth rate should be a little higher than the global growth rate. So from a GDP, that is it. From some macroeconomic indicators, of course, inflation is at about 6.68 as of May, and this is largely driven by the prices of fuel and food. The forex against USD is about 129. It has been stable, but still some pressure, especially from importation demands. Some economists wonder whether 129 is sustainable. There has been, I'm sure you've seen concerns even from the World Bank, IMF, that our forex rates are too stable. And the question is whether it is real or otherwise. The central bank rate, this is the rate that the commercial banks anchor their lending rates. So it was, as of June, at around 8.75%. And this has been stable for May. And the central bank has been doing this just to ensure that the inflation is in check. The GDP growth, the forecast was about 5. It has since been revised to around 4.7, but it also appears stable, though it has dipped year on year. So the inflation rate sharply rose in February from around 4.25 in January to around 6.68 by May. This is, of course, largely driven by the global shocks, external shocks on oil prices, and necessitated by the US-Iran tensions. And so there are pass-through effects that trickle down to other critical aspects of our economy. When the oil prices go up, then transportation, shipping, and everything, and transportation is one of the major factors in the supply chain. If that goes up, then it affects everything else, and so the inflation went up very high. Central bank rate has been reducing, and it has been stayed at around 8.75. It has been quite stable, and I think that is a good thing, because then that brings stability as far as inflation is concerned, but also the price of money, which is interest rate by commercial banks as they lend. That then makes credit accessible. But we are going to see from the budget that there are aspects of the budget that are counterproductive as far as the issue of interest rates are concerned, and we're going to discuss it at that point, especially when it comes to the amount of deficit that the government is having in the budget and the source of funding for that deficit. Okay, so some of the macro outlook issues as well as some of opportunities that we are seeing. The expected inflation is about 5%, give or take, at plus or minus 2.5, which is contingent to the de-escalation opportunities at the Middle East tensions. Like I said, we were hoping there will be some de-escalation, but as you may have seen, Iran is still not very happy. And so let's see how second half of the year will go. The forex rates, I've mentioned that the rate has been stable, but there's some pressure still on the shilling, especially because of the oil imports, both crude oil, cooking oil, and any such other oils that you may know of. We import quite a bit of that. But this has been stayed mostly by diaspora remittances. As you may know, that the dollar that flew into the country, a majority of it, I think more than 50% of it, was a result of diaspora remittances. These are friends, family, relatives from abroad who send money to us. So because of that, then the forex exchange, the forex rate has been stable. The interest rate has been stayed largely by the stable central bank rate, which is at 8.75, and the commercial lending rates has since fallen to about 14.5 from about 17% a year ago. And this means that the borrowing costs for households and businesses has been lowered. And so as a result of that, the inflation may be curbed. Then, of course, GDP growth, I've talked to this. According to the budget, it's about 5%, expected to grow to 5.2. It's a wait and see because there has since been revision of the same. Something to worry is that public debt continues to rise. We are currently at 12.5, about 13 trillion, which is about 70% of our GDP. This may go higher because in the budget alone, we have additional over 1 trillion in terms of debt. So that means we'll be, by the time June 2027 is coming, then we'll be at about 14, 15 trillion, which is likely to be about 73 or so % of our GDP. We have a debt ceiling in low of about 55%. So that means we have overshot that ceiling. And whereas economists warn that that is not very safe for the country, the government is positive that we are still on the right track, and they're actually proposing that the debt anchor should not be GDP, but something else. Right, from a budget perspective, some opportunities for individuals is, of course, affordable housing. I don't know whether this is an opportunity. It depends from which political divide you come from. But affordable housing allocation is 135.7 billion. Now, reports show that there's a report that was presented earlier in the year before the parliament that affordable housing contribution outpaced the demand for construction. So the constructions of houses were slower than the rate at which Kenyans were contributing towards affordable housing. They had quite a bit of money in that fund, and I think a portion of it then was put in government papers, which was not a very good decision, but just so that then we don't have idle money. I'm not sure whether it will be paid back, but it is what it is at the moment. That because of that 135.7 billion allocation, then there's potential job creation and demand for construction materials. It is expected that about 1 million jobs will be created. We wait and see the reports that were given. Of course, something else for farmers is that about 18 billion was allocated to fertilizer subsidy. And the government is trying to push for production subsidies as opposed to consumption subsidies. What that means is that they are subsidizing producers as opposed to consumers. So in the agriculture space, instead of subsidizing the cost of unga, they are subsidizing the cost of producing unga, which is fertilizer. So the government has been at the forefront of doing this, and I'm hoping that we are going to feel it. Of course, there's been complaints that the subsidized fertilizers are not very high quality, but that is for the farmers to tell. Apart from that, of course, cheaper credit, expected cheaper credit, as you've seen that the central bank rate has been stayed or has been retained at about 8.75. The commercial bank lending rates at around 14.5. Then that means there's better refinancing of loans and servicing of loans and access to things like mortgage finance or investment in assets. Again, the budget speaks of about 550 million for MSMEs, but also there's about 32 billion for youth-related funds. So that means then there is quite a bit in circulation. The Hustler Fund alone is targeted at 100 billion. So there's that opportunity for all informal traders and young people. The downside, of course, is the government bond yields. The domestic borrowing has been targeted at more than 1 trillion. What that means is that the treasury bonds still remain attractive. But unfortunately for individuals, you have a very small portion of the pie because a majority of treasury bonds and bills are usually taken by corporate and commercial banks. For businesses, of course, there is a plan to spend about 531 billion for energy, infrastructure, and ICT. And so if you're in that space, then the opportunity is there. Then there is the public-private partnership pipeline that the government targets to develop at 70 billion. So there's a pipeline, not pipeline like a pipeline, but saying PPP projects. Let me just say that there are intentions to spend 70 billion in PPP projects. So that's a good pipeline for PPP projects. So opportunities in roads, energy, and digital infrastructure is there for private sector co-investment. Apart from that, of course, the export value chains are also something to watch because the budget is trying to back leather, cotton, dairy, edible oils, tea, and blue economy sectors. So if you're operating in those spaces, then you need to be close to the government to watch what is happening to take advantage of that. So value addition is going to be something to watch about because there is a lot of backing from the government to export some of these things to external markets. And so opportunity still remains there. Digital economy, there is about 500 and something million, actually, you're going to see, that is set aside for county ward innovation labs. So if you are a grassroots entity, either an NGO targeting digital literacy, then you need to be at the ward level because there's quite a bit of funding set aside for that you can take advantage of to create innovation hubs at the ward level. And so you can have various hubs at different wards across the various counties to take advantage of that. Of course, the disadvantage is the crowding out risk that based on the fact that the government is planning to borrow about more than 1 trillion. Well, that means the government is going to compete. About 1 trillion is going to be borrowed domestically. So the government is competing with businesses for credit. And you can imagine who the commercial banks will give preference. It's the government. So that is something to watch. And so allow me then to give you a brief overview of the budget. Of course, the budget statement carries a a majority of some of these details, but I'll just give an overview of the budget. Then I'll hand the mic over to my colleague to look at the Finance Act. So the budget is at about 4.76 trillion. And that comprises of recurrent expenditure of about 3.6 trillion, development expenditure of about 750 billion, and county governments of about 428 billion. So with that, then we are at about 4.76. How the government plans to finance that? Ordinary revenue is tax and levies. Revenue from taxes and levies projected at around 2.9 trillion. So this has to do with income tax, PS1, VAT, customs, import duties, excise duties, and so on and so forth. 2.9, let's just say 3 trillion that the Revenue Authority has as a target. Ministerial appropriations in aid, these are fees and levies charged by the various ministries when you visit the hospital, when you visit Huduma Center, when you're processing your passport, when you're any service that you pay for. Sometimes the question is, should we pay for services after paying taxes? But I think that's a discussion for a different forum. But yeah, so all those government services that you pay for are projected to contribute 644.8 billion. Then grants, these are donations and bilateral and multilateral donations from other governments, from other agencies, development agencies, and so on and so forth, projected at about 44 billion. And then, sorry about that. I think that means you can mute them. So that leaves us with a deficit of about 1.2 trillion Kenyan shillings. Out of that, 116 billion only is going to be borrowed from foreign sources. About 1 trillion is going to be borrowed domestically. Now, let me focus on that a bit and tell you the difference. So the government will be borrowing about 1.2 trillion Kenyan shillings, about 116 from foreign sources, then 1 trillion Kenyan shillings from domestic market. Why is there a difference between those two sources? One, the benefit of borrowing from foreign sources is that the interest rates are very low. They are very low, sometimes as low as 3%. In other countries, 5%, and so on and so forth. So because of that, it is a cheaper source of debt. So when the government borrows 1 trillion domestically, the interest rates are very high, as you've seen, about 14, sometimes 13%. Last year, it was about 16%. So it's very costly to borrow locally. The downside of borrowing from foreign sources is that most of them are dollar denominated or foreign currency denominated. And that means when there is fluctuation in Kenyan shillings against that currency, then the debt can either balloon or deflate, depending on the movement. And so that is the downside. The downside of borrowing domestically, of course, I've talked about the costs. The interest rates are very high. The second one is that it crowds out. There's a crowding out effect. If banks have 1.2 trillion in total to lend in one financial year, and the government has already taken 1 trillion, that means the private sector and individuals have less than 200 billion access to capital, debt capital from banks. Then that means that private sector will not grow as fast. Now, it's not sustainable to have a country whose private sector is not growing, because it is the private sector that drives economic growth. So if they cannot access capital, they cannot do business, they cannot expand, they cannot export, they cannot serve more clients, then that means the private sector and the economy in general is shrinking. And that has a net effect of reducing the ordinary revenue collection, because this ordinary revenue is to be collected from the private sector. So then it has a vicious cycle. The next year we are borrowing more, or even not even next year, within this financial year, instead of 1.2 trillion, we'll borrow more because the ordinary revenue target cannot be met, because the private sector is not growing as fast, and as a result, there is no income tax, no revenue, no VAT, and so it's not a very good thing to have when a lot of borrowing is domestic. But something else about now borrowing in general, the 1.2 trillion deficit, is that then we have to refinance it, we have to service it. And every year, the amount we are spending, currently we are going to spend about 2.5 trillion in servicing debt. Now, that figure will keep growing to the extent we are borrowing. What it does, it crowds out development and allocation to critical sectors, health, education, agriculture, because the debt service is a must and the government has no choice. So the debt may be growing faster than the revenue for the government, and that means every year the amount left for development and for allocation to critical sectors shrinks every year. So there's everything about debt, but that is the situation currently. So in terms of just comparing budget growth, it has been growing. In 2022-23, it was at 3.3 trillion, then 24, 3.6, 25, about 4 trillion, 25-26 are about 4.3 trillion, and currently we are at that level. In terms of how the same has been allocated, we have recurrent expenditure taking the lion's share, and then the rest, things like contingency fund, then development having the least possible amount there. Now, with this, then it means that the ones who bear this burden is largely individuals and businesses. And so let me go to this slide that talks about how the budget affects you directly. It affects you in the sense that the ordinary revenue of 3 trillion that has been projected will come from you and me and our businesses. Out of the 3 trillion, income tax is expected to contribute about 38%. Then VAT, 23%. Then appropriations in aid, 18%. Then excise at about 11%. Import duty at 5%. And non-tax revenues at 3%. Then other taxes at 2%. So this is why we have the Finance Act, because then the Finance Act is meant to increase some of this. The tax laws as they are will still, of course, lead to collection, but the Finance Act is meant to give additional collection. And the Finance Act 2026 is meant to give about 100 billion in additional revenues. Some of the reforms that we are going to see from a revenue collection perspective is the extension of the tax amnesty program. That means there is a tax amnesty program for taxes not paid as of December 2025. So if you have any penalties and interest relating to periods up to December 2025, including the returns that you filed, if you filed late, then there's a tax amnesty program. So if you have any taxes that you are yet to pay, take advantage of the amnesty so that then you are forgiven. Then, of course, the revision of income tax return filing deadlines, we know, and you're going to see it. that individuals now from next year, you'll be filing your returns by April, and organizations or corporate bodies will continue as usual, filing by June. Something else, of course, capital gains exemption on REITs or real estate investment trusts, and the modernization of tax administration. You're going to see quite a bit on tax administration. A lot of changes, actually a majority, nearly half of the changes through the Finance Act touches on tax administration. The Revenue Authority has been given more powers to access your data from whichever source. They have also been given the powers to file returns for you. If you don't file your return in time, the Revenue Authority will file it for you based on the information it has. It has been given also the authority to seek information about a taxpayer from third-party sources. And so a lot of powers have been given to the Revenue Authority. Ladies and gentlemen, I don't want to bore you a lot. I just want to talk about this final slide on county, and then I'll give my colleagues opportunity now to take you through the Finance Act in about 3 or 4 minutes. So you may know that the county, to a degree, depend on the government, the national government, for their funding. The budget allocated about 500 billion Kenyan shillings, which includes 428 equitable and 74 billion in additional allocations. But something that we are seeing, a trend that we're seeing, of course, the winners there include Nairobi at 22 billion, Nakuru at 15 billion, Turkana at 14.3, Kakamega 14, Kiambu at around 14 billion. But a trend that has been common is, and which is worrying, is the over-reliance of county governments on national government budget allocation. And unfortunately, the national budget allocation to the counties can only, in most cases, fund salaries. So what that means, if your county relies more on the national government allocation, then there's little to nothing left for county development. And so previously we saw, before the county system, of course, we saw that local governments, were very aggressive to increase their own source revenues. This has to do with parking fees, land rates, building levies, permits, natural resource income, tourism, like what we see in Masai Mara and at Narok County and Mombasa counties or coastal counties. So they were very aggressive. But that has since changed. There's over-reliance by the county governments on this, on allocation from the National Assembly, from the national government. And so as professionals, we need to then, those of us who have access to the leadership at the county government, we need to offer our services, to be creative, to suggest and propose to county governments what other ways can the county explore to generate own source revenues. And I'll give you an example. Partnerships and investments is an area that most counties, is a goldmine that most counties are sleeping on. Each and every county has their own strengths. So Homa Bay, for example, you'll see that previously there was cotton growing down there, but over time, things changed. Why can't we get partners, private investors, who can come and invest there, set up factories there, let our citizens farm cotton, for example, or soybeans. I mean, soybeans does very well down there. Then let them set up factories there. Let us earn from that. We may not have money to develop, but if we can partner to just see this county, what is it? And I know the Commission on Revenue Allocation did some research to show the potential of each county and some of the possible potential on-source revenue sources that each county has. Some of those reports, we can break them down for the county governments for them to pursue. And so, ladies and gentlemen, that is a challenge that I'm giving all of us. We all hail from some county somewhere. And so these are discussions. And if you like, we can put together some reports for each county, for your county, and we can show you just the potential, what that potential looks like. What is it that that county can do to increase its own source revenue? Otherwise, then allow me to, let me just speak to this slide. It's a last slide. How we are doing across East Africa as far as budgets are concerned. So Kenya, we are at about 4.8 trillion, which is about 37 billion USD. Tanzania around 23, about 24 billion. Uganda about 23 billion, and Rwanda at about 5 billion. So that means Kenya's budget is still higher than the rest of our colleagues across the region. In terms of year-on-year growth, so the budget for Kenya has grown by 12.4%, Tanzania 10.3%, Uganda 16.6%. I told you there is the oil effect in Uganda, so that's why you'll see that their budget has grown so high. Then Rwanda 10.9%. The question is, do this growth in budget reflect the kind of development we have seen in the past year? If you look at it, in terms of revenue, Kenya at 22 billion, Tanzania at 14 or 15 billion, Uganda at 11 billion, and Rwanda at 3 billion. And actually, Rwanda reported that they surpassed the financial year 25-26 revenue targets. Let's look at allocation to recurrent expenditure. So Kenya is allocating out of the 22, out of the 37, Kenya is allocating 16 billion to recurrent. Tanzania 14 or 15 billion. Sorry, Tanzania is 15 billion, Uganda 9 billion, and then Rwanda 3 billion. That is recurrent. Looking at the development expenditure, Kenya is at 6.2 billion. Tanzania, with a budget of 23 billion, they have allocated 8 billion, more than Kenya, though Kenya has a higher budget. Uganda is close to Kenya with a budget of 23 billion. They have allocated 6 billion to development, and Rwanda 2 billion. So at the development level, I think Kenya is lagging behind, and that should not be the case. So then, ladies and gentlemen, allow me to invite Faith Mungai, who will guide us through the Finance Act 2026 together with Alvin. And I think we can ask questions at the tail end. Otherwise, thank you so much for your time, and we can talk more.
Good morning. My name is Faith Mungai. I'm a tax manager here at Keldin & Co. LLP. I'll be taking you the first facet of the Finance Act 2026. Ideally, the Finance Act 2026, mostly the Finance Act always, every year we normally experience changes in the tax regime. So where you find their transitional clauses, but transitional clauses is where now there are more elaborative changes that are made, for a smooth ride of the tax changes that have been made. Sometimes there are introduction of new tax changes, And also sometimes they also deletion. So that means maybe something that was supposed to be charged with withholding tax, VAT, and sometimes they would be considered, of course, because of the public participation, sometimes guided also by the budget. There are quite a number of affairs that also guide the positioning of also the government. My colleague will be coming later on to discuss on VAT and Tax Procedures Act. The Tax Procedures Act will mainly focus on, you'll notice there will be a lot of returns filing emphasized on the same, the e-teams. I'm sure we have experienced e-teams and auto-population, the returns. And you'll note that the commissioner through the Finance Act 2026, which most of them are now effective because most of the effective dates, except a few, is 1st of July 2026. So I'll just quickly go through the corporate income tax and the pay as you earn, and then so that we create more time for us to understand what KRA is about and what the commissioner of the KRA is, the powers that you also get in through the process. So you just quickly go through the corporate income tax. You note some of the elements might not really, there'll be more of knowledge purposes, but not more of practical purposes. But TPA for sure, it's something that you should lean on to listen, because this is something that will cut across every business. So I'll just quickly go through the corporate income tax and pay as you earn. So as alluded earlier, so for corporate income tax, there's an introduction of non-resident rental income tax, which will be through a simplified registration framework. So ideally, this means if you are a non-resident and you have a property here in Kenya and you're generating rental income, you'll be expected, effective of 1st July 2026, you're expected to pay tax by 20th of the following month, which is actually final. By final tax, we mean you'll not be expected again to come file a return and declare the same income at the end of the year. So this is something that you would note either for yourself or maybe for relatives that you know that they normally are not within the country and they have some rental property that they are generating within Kenya. The other thing is about exemption of installment tax. This is more of just a clean, not really a cleanup, but just an emphasis, because it says to the best judgment or belief that you know that within this tax period, let's say for 2026, that the only income you'll only get is emoluments, which emoluments here are salaries or anything that is subject to pay as you earn. Then if you feel for the year, for this tax period, let's say, for example, 2026, the only income that you'd be receiving is actually salaries or anything subject to pay as you earn, then you are not mandated to pay installment tax. Okay, it has been a practice, but now I think it has just been written into law, which is okay to avoid situations in future where there will be such a mandate. The other thing is in regards to the self-filing, in terms of filing of the returns, as you might have heard across the media, especially when we had the bill, there was an earlier proposal to have new returns to be filed by January. By the first month, so most of them, and by the way, these individual returns, everyone is at December end. So the earlier proposal was to have your new return filed by January. Anyone now having the other return, streams of income from business, from employment, any interest, and any other income that you may have as an individual, it was supposed to go up to April, and actually it was business and corporates were supposed to file by April. But the good thing is, out of public participation, there was the final decision that was actually alluded into the tax is actually anyone with an a PIN that starts with an A, should file your return by 30th of April next year. So your return for next year ongoing until the law changes again. Then you're expected to file your return by 30th of April 2027. And of course, for companies partnership, they can continue filing as usual, that is within 6 months from the end. So if you're December end, then you're expected to just continue filing by 30th of June of the following year. This, by and large, mostly favors those who are in the microfinance institutions. There was a case, a TAT case that was given precedence. So what they're just trying to say is any deductibility of bad debts should now also include principal amounts and interest and any other cost that you have incurred in the course of that particular debt collection. So this is actually more of just an emphasis based on, as you know, some of the time the Revenue Authority would actually come up with a judgment that is not favorable, but the beauty about it, when we have the acts, they come do such cleanups and also shed a light on the same. We'll also proceed with, this is not really a good move, especially for SMEs, but it is a good move for those who have the capital investment. As you had noted previously from the Finance Act 2025, there was a cap into which you would carry forward your tax losses, right? And so it was an outcry, especially those who are in the manufacturing environments and those who have really heavily invested. And through this investment, they have accumulated quite huge tax losses. And so one of the transition clause that was brought in, that if in event you have done an investment of at least 10 billion in Kenya before 1st July 2025, then you're allowed to continue to carry forward your losses until they are fully utilized. Of course, now this means it becomes a pain point, especially to SMEs. And the beauty when we have the window is open again, come December or come early next year, it will be something that you may think as SEC, it's something that you may request maybe the investment value to be lowered to an amount that would favor any SME. In terms of interest deductibility, I know this mostly favors those who are in the financial sector again. Previously, what it was strictly for those who are handling both lending and leasing businesses. Of course, out of the changes and of course looking at the diversification within the MFI sector, there was now an introduction that now by expanding, by actually allowing, whether or not you are not giving an allowance to those who are just strictly doing lending businesses or leasing activities or both. So in case now from effective 1st of July 2026, you're only providing your leasing lending activities or leasing activities, you do not provide both, then it means the interest deduction on such become exempted on the same. This is just like an enhancement. You know, sometimes these changes of the act normally bring, because they borrow from various also, especially definitions. These times come from, you know, the various acts within the jurisdiction of the sectors. So this is just a replacement. It's not more of a tax. There's not much of a tax implication, but it's more of an alignment between the tax legislation and also the insurance registration by just replacing the life insurance fund with the statutory fund. Of course, we can look at the amendments in the act that were not in the bill. So as you notice, we normally begin with the bill. And then once the bill is furnished, mostly it will come there about around March and April. Of course, there will be an open floor for public participation on the same. And the parliament and they will also listen in, our MPs will listen to the outcries from the various citizen here, stakeholders, even like yourself. And of course, there are things that normally come up when you go to present, and from the various stakeholders that normally do the public participation, that they pick 1, 2, 3 items, and out of the items that they may pick that were not initially in the bill, they actually brought within the law. So these are among the items that were not initially in the bill, and maybe through the public participation, they had picked 1 or 2 items which were slotted in. Majority of them are what we have just discussed in terms of the tax losses, trying to bring the 10 billion. Of course, this is an opportunity for us come next year, whenever there is a public participation on the same. It's something that you may consider trying to do public participation and trying to lower the amount, so that actually it also favors the members of the community. Of course, they trying to segregate them from the MFI sector, trying to segregate the lending and leasing businesses, because it was also noted from the MFI, the CPA Act, that not everyone, is actually handling both businesses at the same time. So these were great moves, and that means this is just to show you that the public participations that you normally see them in the news, they actually good moments, and actually the parliamentarians listen to them, as long as of course you actually back them up with the correct documentations. We'll go quickly to personal income tax. There weren't much changes. Actually, there were just 2. One of them being exemption of death benefits. Of course, it means if your loved one has now departed and there were any emoluments or anything that were supposed to be beneficiaries, that amounts that were supposed to be received by beneficiaries and dependents are now been explicitly been exempt. So it means there's no much tax burden. It's sad someone has left, and there's also tax burdens again for someone who is already bereaved. So this was actually a good move. Of course, exemption for certain gratuity contributions. This is mostly the current rate was actually, the exemptions were actually capped up to 360,000. But of course, now they had to expand the conditions. So these are kind of move expansion of the tax laws from a terms and conditions apply. So of course, for the exemption to be considered, the employee must have served the employer for a continuous period of at least 3 years. So that includes whether it was maybe a fixed term maybe renewals of the contracts, or sometimes extensions that go beyond 3 years. Of course, the gratuity paid should not exceed 31% of the employee's emolument and during the contract period. So this is just more of an expansion and including more terms and conditions. So where they included both of them. We quickly go to withholding taxes. I think the main issue here would be expansion on management and professional fees, because I know majority of us, both in the SMEs and on an individual capacity, we normally do a lot of paying online. Nowadays we are all on the digital payment ecosystems, various of them making payments. And of course, there's an introduction of withholding tax on interchange and merchant fees that are rising from card-based payment transactions. Of course, that means now the cost of operation of the bank charges now will also increase because of the withholding tax implications that have been brought about. The other thing is something that you note. This is not majorly affecting everyone. It's something that you note sometimes. The law, sometimes they start now taxing those areas that are by and large what we feel are informal sectors. And one of them is usually the scrap metals. I know we have interacted with such businesses before. So there is reintroduction of withholding tax on scrap sales. That is 1.5%. For both residents and non-residents. So it means such personnel, before making payments to them, if you have purchased scrap metals from them, you need to deduct 1.5%. That's as we normally do when you engage a lawyer or professional services. You always note that when making payments to people like us, like Keldin, you have to withhold 5%. So in case you're in a business where you interact with a scrap metal dealer, worth noting that from 1st of July 2026, as you make the payment, you just require to deduct 1.5%, which actually you're supposed to also remit the same to the Revenue Authority. Of course, within 5 working days. Of course, there is exemption of withholding tax on certain digital payments paid by the national carrier. This is actually just a way of just trying to make it friendly, and especially to the national carrier that is serving the non-resident persons. And of course, it makes it, Kenya more habitable, because you can imagine if we are making payments, we are withholding on everything, and especially when non-residents are actually coming within the country. So I will just now introduce my colleague, Alvin, who will now come run you through the gist of where the Finance Act 2026 is sitting. That is the Tax Procedures Act. You note there will be quite a number of changes and more emphasis on KRA. There are a lot of, emphasis on pre-populated returns, e-teams, timelines of filing the returns, and quite a number. So I'll invite my colleague, Alvin, to proceed with the tax administration section and finalize with the value-added tax section.
Hello, good morning, everyone. Thank you, Faith. Welcome to once again host this webinar. I'll be taking you through tax administration and also the VAT section, and we'll just run through quickly in the interest of time, but also we'll try to capture every important detail that may affect you as a startup or a small business. So to start us off, the Tax Procedures Act has been amended to include subsection 9, 10, and 11. And this relates to reinstatement of your VAT PIN. Suppose you had deregistered before and you want to be registered again as a business. And this is relevant for maybe a startup that wants a registration into the for tax purposes. So you are allowed to do that, but perhaps the most important amendment of this is the fact that if you had tax liabilities before, you will be expected to pay these liabilities because you'll be given the same PIN that you had when you deregistered. So this is just to flag it to you that deregistration does not save you from tax liabilities in the future when you decide to register again. Also, another amendment is the introduction of Section 18A to the Tax Procedures Act. And this is to strengthen against tax avoidance. Previously, this section existed in the VAT, but it was repealed, Section 66, and it was brought here. A section also existed in the Income Tax Act, but it has been brought now under the tax procedures. This, of course, is an effort by the KRA to to harmonize these acts and these laws and to place this under one particular act. And of course, the most important thing about this, or what you need to know, is that the commissioner is empowered to disregard any tax avoidance arrangement that you enter into. And now the next question would be, what will the commissioner use? The commissioner will use, like we had been told before, third-party data or data that is available for KRA, maybe on iTax or the withholding tax records. So while tax avoidance is illegal and it's allowed, the commissioner is allowed to disregard all that and to use the records that are available. The record transmitted through maybe eTIMS, or KRA is also allowed to look at maybe your bank to see the money that is coming in and to compare it with whatever you have filed and to raise an assessment and to demand for more taxes. The other important amendment that should be relevant to you, especially if you're importing, is that you won't be allowed to claim any tax refunds or refunds relating to imports unless you produce an export declaration documentation from the exporting country. So if you are in the business of importing goods from another country, you are encouraged to have the documentation, export documentation from that other country in order for you to be allowed to claim any tax benefits or to claim any taxes, to any refunds to offset your tax liabilities. So this calls upon you to keep proper records, especially for 5 years after importing, so that upon review by KRA, you can produce such documents to support your tax claims in case you imported. Section 29A of the Tax Procedures Act is also amended to allow KRA to use, or the commissioner to use, third-party data. Like Joseph had mentioned before, KRA can even be allowed to file your own returns for you, because we are moving into real-time transmission of both sales and expenses. So, and there is a lot of data matching that KRA has started using and will use into the future. So, like I mentioned before, KRA is allowed to look at your bank statements and to compare the credits into your bank statements with what you filed and issue an assessment and issue maybe additional tax liabilities. So this calls upon you as a taxpayer to do regular reconciliations. Look at your withholding tax records, because KRA can look at that. Look at what you filed in VAT versus what you have in your books. Do your reconciliations regularly. Maybe before you do your VAT, you can reconcile what you're filing with what is in your books, because KRA is empowered to use all that data to match and to tell you that there are inconsistencies. So these reconciliations will help you to be able to explain any discrepancies or any variances that arise when this data matching comes out. Section 39 of the Tax Procedures Act is also amended to empower the commissioner to use the same mechanisms it uses to recover unpaid taxes, to also recover unpaid fees, levies, maybe catering levy, and other charges. So if you have any liabilities in terms of fees, levies, and all the other charges that are not tax, KRA is still empowered to pursue you to recover all those using the same mechanisms it uses to pursue unpaid tax liabilities. The amnesty, the tax amnesty that has been talked about by my colleagues, it is here, and perhaps the most important thing that I can tell you or to guide you on is how to utilize it. If you have liabilities up to December 31st of 2025, you are allowed to, or this can be waived, provided you pay the principal tax before December 31st of this year, 2026. So perhaps the best thing you can do right now is to, like Joseph said, do a tax health check and look at the liabilities that you may have. Of course, if you already have liabilities, it calls upon you to pay the principal, so that the penalties can be waived. But also you can take advantage of this by doing a tax health check and assess the principals and maybe the liabilities that you have and pay the principal. And of course, Kelvin has a tool. We have the tax risk diagnostic tool. It has been posted in the chat. It is free and it's sufficient. It's even fun to use. You can click it, do a tax health check. There are a set of questions we will answer. And at the end, it will give you your risk, whether you're red, which is high risk, whether you're amber, and if you are green, it will also show you. So if you're amber or red, you will take this opportunity, the amnesty opportunity, to have your tax health check done, so that if in case in the period up to 2025, 31st of December 2025, you have any liabilities, you can maximize this before the amnesty period ends. So you can just go to the chat and utilize that. You can copy the link and even use it later. It is free to use and it's fun also to use. Again, the Tax Procedures Act has been amended also with regards to virtual assets. So people dealing in virtual assets will be required to report the transactions. And this is just in a bid, the government's effort to tax this growing space of virtual assets, and also to align with the international practices about taxation of virtual assets. So should you be dealing in such, or you are a virtual asset provider, you will be required to issue this information, especially on the transactions. Okay, so you will notice that Tax Procedures Act is really preparing you for pre-populated returns, or is really preparing you for data analytics by KRA or data matching. Like now, Section 75, as you can see, there is the generation of pre-populated tax return, which KRA will be able to rely on pre-filled returns. That is through the ITIMS data that it will receive. So as we all know, the manual CSVs won't apply from 2026 going onwards. And this just calls upon you to, especially on the expense side, ensure that every expense you receive or every expense you incur as a business, you get ITIMS, because this will be transmitted real time, and that is what KRA will use. So this is just a wake-up call for you to get ITIMS and also onboard ITIMS, because if you are supplying, your clients will require you to give them ITIMS receipts because of this new era of pre-populated returns. These returns will be pre-populated purely because of the ITIM system that has now been insisted on by the KRA. So there has been an existing section in the TPA that allows waiver of penalties and interest arising from system errors. We all know that ITIMs and even the ITACs can sometimes experience malfunctions, and this act expressly allows your penalties to be waived if you can prove that indeed the system malfunctioned. Maybe you are filing your VAT on the 19th and the system malfunctions till 20th, or even the Excel itself has errors which you have tried to fix or to follow up with KRA. So it just calls upon you. It's a wake-up call also. When you experience these errors, you should document them, take screenshots, email KRA or visit KRA, preserve the correspondences, and also just to ensure that you can demonstrate that indeed there was an error, so that your taxes can be waived. So this amendment specifically, it narrows down to system malfunction, which can be frequent in the case of ITACs or even ITIMs. Section 86 also is continuously now enforcing the electronic compliance. And so the Act says that you will be penalized if in case you fail to transmit your data, of course, especially sales through the ITIMs. You are required to do this for visibility, for transparency, for real-time data submission to KRA. So, of course, there are those penalties that we will incur if in case you fail to comply with electronic tax transmission. So this calls upon you to onboard ITIMs, transmit your sales through ITIMs, and just to remain compliant. Sorry, my slides are not functioning very well. Okay. Thank you. Okay. So, of course, there are those provisions which were in the bill but were dropped. And perhaps the one regarding Section 47 would have been negatively consequential. It sought to restrict utilization of overpaid refunds to offset import VAT, but it was dropped. As my colleague said, these public participations do work. They do work. So as you will see, even in VAT, there are certain provisions that were dropped that would have been detrimental to you as a taxpayer. I'll proceed to value-added tax. So for those businesses that, if you are maybe a business that deals in employee outsourcing and you incur employee-related costs, the introduction of Section 13 is a welcome move for you, because it expressly states that these costs should be treated as disbursements and not be taxable supplies. And this is a very welcome move, and it will limit the disputes that have been occurring. We see it as a response to some case laws like the Stratostaff case law, where the Tax Appeals Tribunal upheld that employee-related costs should not be vatable, but now the High Court overturned it and said that this should be vatable. Of course, the introduction of this section 5A, 5B now makes it clear that salaries, wages, and all that employee-related costs for providers of employee outsourcing services will not be vatable. But of course, you have to maintain proper documentation to show that indeed there were employee-related costs. Section 17A was also introduced to provide that where you are supplying goods which were previously vatable but become exempt while still remaining unsold, you will be required to reverse the input VAT that you had previously claimed. Of course, this will be detrimental to you as a taxpayer, and it will place more burden on you because you will have to maintain records and to trace your goods, your inventory, to ensure that, and also to keep an eye on tax changes that may affect the rates of your supplies. So if your supplies suddenly become exempt while still remaining unsold, while filing in that period, you'll be required to refund the input VAT that you had previously claimed. There is also extension of the VAT bad debt relief. The bad debt relief, which was previously given a limit of 2 years, has now been extended to 3 years. So, of course, this is not welcome because it will give cash flow constraints to businesses. Say you supplied us some goods and you've incurred bad debts. You have to wait for 1 more year, an additional year. Previously, it was 2 years. Of course, our interpretation is that by the 2nd year, there is every reason to believe that you won't be able to recover that bad debt. But of course, this is a strict strategy by KRA also to obtain reasonable proof that indeed that is a bad debt and you deserve refunds. But of course, it will have negative cash flow consequences on the side of the taxpayer. Section 13 of the VAT Act. Of course, it always existed that financial charges under hire purchase arrangements are exempt from VAT, but this act now narrows it to hire purchase businesses which are licensed as per the Hire Purchase Act. So if you're running a hire purchase business, the financial charges will only be exempt from VAT if you comply with the Hire Purchase Act, and that will require you to get license as per the provisions of that section. About issuance of tax invoices, this act previously in the finance bill wanted everyone, not only registered persons, but also anyone in business to provide VAT tax invoices whenever they sell. But of course, that would mean that people even not registered for VAT would have to charge VAT, which would contradict the tax laws themselves. Of course, they had to drop it. And they now expressly say that an invoice with regards to a taxable supply should show VAT, in that VAT should only be charged with regards to taxable supply. Of course, if you're not registered for VAT, you can issue items, and it's our interpretation that you can issue items, but you should not charge VAT when you are not registered for VAT because you won't file it. Of course, there are certain changes in rates, specifically for the ones that may affect you, not only as a business, but as a citizen, include the inputs for manufacture of pharmaceuticals. Previously, they were zero rated, but now they are exempt. Much as exempt means zero and the VAT is not charged, but the manufacturers of these products will not be able to claim input VAT. And this will mean that the final products, the pharmaceutical products, will be a bit expensive because when they are zero rated, the manufacturers can claim input VAT, and therefore they will charge lower prices on their products. Also, solar batteries, they're moving from zero rating to standard rating. Of course, this will increase the prices. BEV stores moving from zero to exempt. It may look like there is no change, but there is change. It's more favorable to have a product on the zero rated side than on the exempt side. Scrap metals moving from standard rated to exempt. Of course, in the short term, it will look like it will positively affect prices for consumers. But in the long term, of course, the manufacturers or the dealers in these products will charge higher prices because of the inability to claim input VAT. Other supplies which are moving from standard rated to exempt, of course, include granting of credit and realization of collateral. From exempt to standard rated, digital payment processing, spare parts for direct and exclusive use in official aid-funded projects, and also inputs for tourism facilities and recreational parks. There were amendments in the Act that were not in the bill, like Section 13 that we had looked at before, where it was a response to certain case laws that have gone even to the High Court. And so, as a supplier of employee outsourcing services, any employee-related costs will be exempt from VAT. So that was just to make it clear, because they will be treated as disbursement. But one thing to note is that you need to have supporting documentation. The supply of goods for direct and exclusive use in implementation of infrastructure projects undertaken and funded by the National Infrastructure Fund. Of course, that is not very relevant in our case. And of course, there are those proposals that were dropped in some of our submissions during the public participations. We included some of this, like they wanted to move electric motorcycles and buses from exempt status from zero rated status to exempt, but they dropped those proposals. Also, the inputs for manufacture of animal feeds was to move from zero rating to exemption. This was dropped because this would have meant increase in prices for the final products. Some others include the exemption of transportation of sugarcane to milling industries. This has been retained as zero rated, and also exemption of imported or locally purchased funds. Thank you very much for your time, for attending this training. It's now an opportunity for you also to give your comments or questions. You can type in the chat, and we will be glad to answer or guide accordingly. Thank you very much.
Thank you, Alvin. Thank you, Faith. So we welcome anyone with Q&A. I think someone has asked on the chat. Oh, sorry, our slides did not include our contact details. But Alvin, you can drop your. Oh, I see. Faith has already done so. On Faith or Alvin, you can also share, maybe privately, you can also share your number with Jack. Any other questions? Any other questions that we may have? You can put them in the chat, or if you want to speak, you can request to be given the opportunity to raise them. All right, so it appears it's clear, or you're still trying to digest. So if there's no other question, I want to thank you so much for spending time with us. I want to invite Mercy, the CEO, to take us to the next steps. I think it's just to close the session. So Mercy, karibu.
Yeah, no, thank you so much, Joseph, Faith, and Alvin. Really good insights that have come up. And there's really a lot to actually unpack. I think the reason why we're all silent is we have to go and digest. So I've just shared the feedback form in the chat. If you can share with us also your email address, and then we can also send you the recording and also invite you for further sessions that we're going to be having in the future. Just to let you know that next week we are hosting our Learning Week series, and we're also going to be unpacking a lot more other things around business model, environmental social governance, or what they call ESG, something around AI and how to actually leverage that in your business, and many other topics. So please, I'll also share the link on the chat, and then you can also register and be part of that. But I think for us, just to say asante sana for being here on the call, and looking forward to seeing you in the next and upcoming events. Yeah, thank you so much.
set the alarm Monday to Friday. Ambapo tuna 50 have so many minutes to get up, okay? So just set it at exactly 3. Monday to Friday, ikipamusha siku Monday to Friday, 5 days. Hata watu wa deni itafuata. A lot of love. Hey, guided. Every time we get in class, ORP, RP, I for us, big money, ORP, attend inakuwa mzuri, na ya 3. Na 4, ya ile ya 4 ya America inakuwa hivi. Attend, you cannot miss it. What you can test on here. Sasa hivi ya in the morning. Guys, RP time we get in class, ORP. RP, time for us, big money, ORP, attend inakuwa mzuri, na ya 3. Na 4, ya ile ya 4 ya America inakuwa hivi. Lakini hii attend, you cannot miss it. What you cannot miss it. Kwa DRC, hii nadharia ya wondering if the broken pieces ever really ever said how'd I get here? Didn't do things wondering things by mistake, trying to change, wondering do things by mistake, trying to change, wondering one of the, especially kama una trade na sio vile kama una a lot of trading this same strategy in variations, and the reason why they are trading it very effective this time, and they are using a very repeatable pattern. That is, the market is opening in space. They're either going up or down, and our job is to just trend. Wakienda juu tunaenda nao, wakienda chini tunaenda nao here. So struggle, trade, enda kwa link my bio, join the classes there. The first link
ni kama video watu wangu Kenya na American Home tena kama mnaona traffic agent
thinking about mistakes I made, trying to change the past, wondering if the broken pieces ever really last. Have you ever sat up? How'd I get here? Did I do things
thinking about mistakes I made, trying to change the past, wondering if the broken pieces ever really last.
Hello. Sorry. Hai, sasa. Yeah, iko na confusion, eh?
Is already shortlisted.
Shortlist interviews za nini?
So now I'm wondering, shortlisted, what do you mean shortlisted? Did they already send Gorilla? They didn't, they haven't.
So
Hawajatuma
labda yeye
Gorilla.
alikuwa anakuambia mambo ya Saru.
Shortlist nini ili sasa watu watumiwe Gorilla, I think.
So watu wametumia Gorilla, mimi sijui. Because today is on Thursday.
Anyway, budget was approved actually. And that's why probably walikuwa wamesema laptop tayarishwe. Then akina Andy, I think wakasema they'll work with whatever stuff they have for now. Ati wafanye extra time. Ati called taking some stuff out of the need to go do training for new hires. Apparently beats logic. That's what they think.
And why were they
Yeah, so
hiring?
they prefer people to do extra. See, I don't know. But I'm telling you, your kitu ya extra time ya Saru, kitawaramba. It won't end well. Eh? It won't end well. They'd rather just have hired. So now they maybe wait for the Gorillas.
Haya, wacha basi tungoje Gorilla.
Budget was approved.
Oh, ndo mmepata email ama mmeambiwa?
No, Siti, I'm telling you, it's Buliba ameniambia. Sinakwambia nilikuwa namuuliza why they are overburdening us instead of hiring. Akasema kwanza tuko na interview next week. Interviews next week, then I'm like, which interviews na hata hamjatuma Gorilla? Anyway, let's see what they'll do.
Sawa basi.
Also, just keep checking your nini, especially jioni.
I will. Nasema, I will check. Hello. Mbona umekata?
You're not talking.
Si I'm talking, nasema I will mara kama 50. Oski. Haiko imezima.
But you know you never know what you have done. Nothing is possible with you.
There's nothing because I'm holding my phone.
Yeah.
Haya, wacha tungoje basi. Haya, okay.
So, but hawajatuma Gorilla because Junior would have told me and she would have known because of her sister. So chat her up and ask her is how.
Nani?
But other, see, Nani, what is it called? Nani, Junior. Si akona phone yake?
Yeah, I think I can phone.
Let's just wait and see anyway. From the bus car, whether they send the bus car anyway.
City Alaska, sawa.
Si wametufanyisha monkey huku. Here, there. Then why were they hiring?
I know. Si ni ujinga.
At that point, everyone they had hired there will have applied for this other position and got it and accepted. So now they'll do it again. They'll have to hire again.
Ni ufala sana.
See now, like everyone will be looking to give a job back. Then see atakuwa amepatiwa job, ameshapata job. Yeah, or everyone.
I know.
Because if you're told to pick Saru and these are the ones, which one would you pick?
Si Saru.
Never pick Saru.
I think yeah.
That's what you say. Eh?
Yeah.
Kwani tunaache ni kubaya aje?
Si mnasemanga mnachoka. Yeah.
You can change from new position.
Mm.
3 months, 20 days. Kama mmeweka hivi sasa wata have to do the interviews all over again.
Yeah.
But I think they thought of that. If they want
Okay. Haya, wacha basi tuone. Mm. 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 Okay.
to get the questions.
Mm.
Oh,
I know.
who's not enough?
Eh.
Wait, is she giving up?
Bado naona kuna other nini. Another way.
Yes,
Mm.
we need to answer those questions.
Mm.
Yeah.
Aya, sawa wewe.
Okay.
Hello, sasa. Mko poa sana. Hizi ma-email zako, mbona unatumia manamba nyingi kila mahali? Unaona sasa inakucost.
Inanikosta aje, inikosta.
Sasa cause hata nikiweka hii code itatuma kwa ile recovery email yenye ulikuwa umepeana of which hata ukumbuki. Because now you've created a new one. So sasa hiyo una create a new one. Unaona? You have a new one. Si zile mbili umenipatia, si ndio? So hizi huwezi juu hata ikisema imetuma mali itatuma kwa hizo email na huwezi login huko either way, unaona?
Kitu na need ile simu ingine ya mke.
Haujaichukua hiyo simu. Why? Sasa make sure
Alikuwa atafute betri.
hiyo simu yako unafanya shopping. Hii simu imekaa miezi 6 kwa fundi.
Kwenda huko.
Si ni kutoka last year ama ni wacha nikwambie. Hiyo kitu anaenda anachukua pati yako moja, anaenda naeka kwa simu nyingine, anakuwekea fake.
Anachinja.
So battery iko ilikuwa na issue gani?
Battery si ndio ilidai.
Kutoka hizo miezi zote hadi sasa hajaipata battery.
I think wenye tuliacha kufuatilia wenye bro aliacha, najua ni fundi wa bro.
Wewe hapo umecheza hiyo simu itarudi hapo ikiwa maututi. Hawezi niambia simu imekaa, I think imekaa even more than 2 months. Kwa fundi.
Imekaa 2 months.
Aji sasa. Anyway.
Mungu akwambia nime-give up.
Mimi nilikuwa nisha login kwa account yako saa hii na nikatoka.
Uko sure yeye amweka wapi?
Si acha ni login. Kaa kwa simu. Unajua itanitisha code tena. Use phone number. Copy. Calm down. Nitumie hiyo code.
Nakataa.
Labda inakuwa umelog usi sign up. Unajua yangu inakutumia nini ya verification that I'm not a robot. Nitumie code nimekutumia ama unisomee. Si inakuja kwa message Abi.
Nakuja kwa WhatsApp 833 218.
Mbona leo natupa mbao hivi?
That's true.
Verify it's you. Ndio hii Gmail. Sasa hii nini? Haya, imetuma sasa, sijui kwa email gani. Yeah.
Ulikuwa umelogin aje?
Nilikuwa nisha login, hata niko na sasa imetuma, kuna email inaisha na hii huko mwisho. Sasa nione. Kuna kitu email yako inaisha na hii.
Hii.
E@gmail.com.
I'm going to make picture screenshots.
Ngoja kidogo. Hebu niambie yenye imekaa. Code rather.
Code 051411
051 451.
11 411.
Nimesema login na password yako. Other than email. Si ndio hii, huyu picha yako ni profile, ngoja. Nataka video call, uamini. Majawabu yako ni kwa Tintom. Haya. Unaona? Siuzi ni wewe. Hapa naona bike. Tuko na simu mpya, acha nipanguze. Unaona? Iko na picture imeandikwa
Tumia sahi.
ya UK. Sasa mimi niko hapo.
Niko nayo.
Hii ndio ina retrieve. Ukinipe namba yako, unaona? Hizi za bikes, unaona? Ndio hizi ni whatever.
Hii ni ya show. Yenye nilikuwa natumia ya show.
Sasa mbona na hii namba 36 ni ya nani sasa?
Chini yangu.
Na IG yako personal register na? I mean TikTok.
TikTok.
Email.
I guess ile namba nilikupeanga.
Gani?
Email.
Email. TikTok yako.
Try na hii namba na text.
Kwani uko na namba ngapi? Sasa ni namba gani na text?
Sio nilikupatianga ya Safaricom.
Sasa umenipe namba mingi, mimi hata sijuangi ni gani which is which. Acha niingie TikTok. Na si ndo ungenipe hapo awali.
Hapana.
Hii ndio like your main accounts. Wacha hii ya bikes. Ile yako personal accounts. Na mbona kunipea personal account unanipea hii?
Mimi hata sikuwa nakumbuka. Mimi sikumbuki.
Wewe unafanya PE.
Ni nini?
Ama nitablock hii account ya bike hapa. Unajua ni wapi ndo. Ni report.
Adaku block.
Sinaweza block, niko hapa ndani. Iko wapi sign out? Log out. Unajua lazima ni. So itabaki ukilogin sijui kama uko itakuitisha password. So unaona juu nimechange. Amenipatia hiyo namba ya 0736. So now you need to use a new password. Hiyo yenye nilicreate. Shida yako.
Kwa hiyo ilinionyesha you have been logged out.
Juu wewe ulinipatia namba hiyo. So nikaeka password nyingine.
Lakini sasa iko sawa.
Haya, sawa. 93497. Na uko na hii simu hapo?
Sasa hiyo mimi sijui uchoose kama kuna pale ya kuchoose uchoose SMS. Sasa hiyo iko WhatsApp.
So kuna shida mingi, hata sijui utasaidika aje.
Nikikwambia niliachana na hizi accounts na create ingine. Si ati sikuwa nimejaribu hizi vitu zote.
Kwa umejaribu hizi vitu zote. Basi sasa wewe
Nikaona inani frustrate.
wewe ndio nipe nini mbaya, namba mbaya. Hebu let's hope imetuma SMS. Hebu check. Kwa hiyo namba ya 20 hii yenye umetuma saa hii.
Bado haijakuja.
Basi imetuma WhatsApp most like. Hii namba iko registered na WhatsApp.
Ni register kwa WhatsApp.
Juu imesema imetuma cause hapa si ina count 34 seconds vitu kama hizo. So most likely
Nimejua chenye nitafanya. Sinaweza add account kwa hii WhatsApp.
for something me I don't even know use phone. Cause inahesabu nini?
Unaweza kuwa na
But si ulikuwa na hii namba nishai kutext nayo.
hapana ulinicalling. Add account. Add WhatsApp account.
Kisha maliza hizo shughuli zote utaniambia. Cause lazima ni resend WhatsApp. Haya, kata simu. Hello, Sheila. Sasa, you still asleep? Kwani umeanza trading? Niliona ukicomment mahali. Umeanza trading?
Nimeconnect mahali ni trade. Jana wakisema venye wanazifanya.
Have you started? Umejoin hizo classes?
Bado.
Kwa nini niliona usema? Anasema saa 9 ya huku ama saa 9 ya US?
Nasema 3 AM.
Oh. Aya, sawa, okay, amko nipigie basi.
Hello.
Halo, umenini?
Ah?
Isha register?
Eh,
Unajua utanilipa. Kuna kitu ya bure hii Kenya. Nasema ujue utanilipa. Hakuna kitu ya bure hii dunia.
ukituma code uniambie.
Wewe cheka cheka tu, hakuna naweza block hizi accounts. Ujue niko na zote.
Ati
Ndio inatuma.
ulianza
Ngoja kidogo. Ati niliacha. Mbona na hang up? Haiwezi function.
siwezi switch accounts nikiwa kwa
Ina verify kakuku hapa robot send code. Ebu hang up ucheki. Inahesabu 57 seconds. Hello. Inasema this phone number isn't registered yet. Ama ni mimi nimeandika hii namba 934. Inasema hii namba iko create an account with this number. Sasa hivyo ndio ananiambia.
hii namba tunaongea nayo 0702.
Hmm. 0702 hata anajuta blokiwa 295 tuone. Some sending code tuone. Na username yako ya IG ilikuwa TikTok. Sorry. Tatua kidogo tu. Use phone number. 702 295 273. Nilikuwa naweka vitu zangu. Not too much at one. Hizi masilhouette zinachokesha. Let's verify. Inafaa kuwa inatuma code kama haijafika bado. Five 96 266. Login. Just wacha nikuwekee password sahi. Naweka ile tu. Change huko tu. Try to log in, use your password. Yeah, it's your password. Inaniita password, goja kidogo. I try to use email. Tuesday. Email, unaweza kumbuka email. Juu sasa tuko hapo kwa two-step verification. Use email. Juu sasa hapa your code was emailed to sijui G ** alafu inaisha na 4@gmail.com. Sasa hizo ni email gani tena? Hiyo mpya. Hiyo sijui Gmail for hapo ndo imetumwa some verification code. Wewe uzisaidika. Hizi my email, yani uko na email kila mahali. Like email ya huku basi imesema hiyo ticket iko in progress. Bado hajai nini? Na wamerecover. I guess kitu ilikuchanganisha ni hizo my email mingi. If you're logged in, settings, account recovery, yeah? But huja log in. Shida ni hizi maemail zako 1 million. Because kama so lazima tuta contact Google. Kwa sasa like unafaa kuona unaona hizi Gmail si create ingine the time uta recover uweke kwa account moja, useme kama ni mpya, hizo mbili zenye ulipoteza useme another